Welcome to the Deep Dive, your go-to source for getting truly well-informed quickly. This is your Talk Ticker summary, and today we're going to dive into the latest from Cracker Barrel Old Country Store.
Yep, their fourth quarter fiscal 2025 results. Call dropped after market close yesterday.
And, well, like you'd maybe expect with an after-hours release like this, the market reaction, it told a story. Pretty significant adjustment by investors.
Absolutely. So our plan today is simple. Walk through the numbers, unpack what management said, especially about their strategy shift.
Yeah, and figure out what the road ahead looks like, particularly with all that recent brand stuff.
Right. So Cracker Barrel, they showed kind of a mixed bag financially for Q4.
Some good, some maybe not so good.
Exactly. There were some bright spots, actually, but it seems like the forward-looking guidance, that's what really grabbed investors' attention.
And maybe not in a good way.
Led to an immediate, pretty noticeable drop in the share price.
Oh, man.
Yeah, the outlook really overshadowed the Q4 results themselves.
Okay, let's get into those core numbers then. Adjusted EPS earnings per share that came in at $0.74.
Which actually missed the consensus estimate.
Yeah.
Wall Street was looking for about $0.77. So a slight miss there.
Okay, a bit of a disappointment. But revenue, you said there were bright spots?
Revenue was one, yeah. Reached $868 million, which actually beat the consensus of around $854 million.
So bringing in more money than expected, but maybe less of it hitting the bottom line per share.
That's the picture. And if you dig into comparable store sales at existing stores, it's really a tale of two different areas.
How so?
Well, the restaurants saw a pretty healthy jump, 5.4% increase. That suggests the core menu is doing okay. People are responding well.
Okay, that's positive. But the other side?
The retail side, comparable store sales there actually decreased by 0.8%.
Not huge, but a decrease nonetheless. Maybe suggest the country store part isn't quite the draw it used to be? Or people are just shopping differently now?
Could be. It's definitely a yellow flag. Now, profitability, adjusted EBITDA, that gives us a view before interest, taxes, depreciation, amortization.
Right, the operating performance.
That was $55.7 million, which is actually up about 8% if you exclude the extra week they had in the prior year. So some underlying strength there.
Okay, so operationally, stripping out that calendar quirk, they showed some growth. And what about returning cash to shareholders?
They announced a new $100 million share buyback program, and they kept the quarterly dividend steady at $0.25 per share.
Which, on the surface, sounds like confidence, right?
Yeah.
Buybacks, dividends.
It does. But like you said, with EPS missing and that guidance causing concern, it adds, well, another layer to think about. How does it all fit?
Let's dig deeper then. Those detailed financials must paint a clearer picture.
They do, and it's nuanced. So that total revenue number, yeah, it was down 2.9% as reported. But that's only because last year had that extra 53rd week.
Ah, okay. So if you compare apples to apples.
Excluding that extra week, revenue was actually up 4.4%. So the core business is growing year over year.
Got it. And the driver was the restaurant side.
Definitely. That 5.4% comp growth in restaurants, that was the fifth quarter in a row of positive growth there.
Wow. What was behind that?
Mostly pricing. Their price increases accounted for 5.4% growth, and then a slightly better menu mix added another 1%.
Interesting. And I saw off-premise sales, takeout, delivery that also increased.
Yeah, up to 18.1% of restaurant sales now. That's a pretty strong shift.
Shows how dining habits are changing. But again, that slight dip in retail sales, it's still something to watch.
For sure. Now, costs. Commodity inflation was running about 2.3%.
What drove that?
Mostly higher prices for beef, pork, and eggs. They got a bit of a break on poultry and produce, though.
And what about the retail side costs? Any specific pressures there?
Yeah, tariffs hit them. An extra $2.4 million in tariff expense impacted the retail cost of goods sold. So that's still a factor.
Still a factor. But I saw a positive note on labor costs.
Yes, that was good news. Labor expenses actually improved by 100 basis points. That's 1 full percentage point as a percentage of revenue.
So better efficiency.
Seems like it. Driven by their pricing and productivity gains, even though they faced about 1.1% wage inflation, shows they're managing those costs pretty well.
Good sign. But not all costs was down.
No. Other operating expenses ticked up, partly because of more advertising, which kind of makes sense given the brand situation.
Try to get the message out.
Right. And also higher depreciation. And this is important. The GAAP results, the official accounting numbers, included a $16.2 million non-cash impairment charge.
Impairment, that usually means they think an asset isn't worth what's on the books, right?
Exactly. Mostly related to underperforming Maple Street Biscuit Company stores.
Oof. 16 million is not small. What does that signal about Maple Street? And maybe broader issues.
It's definitely a signal they're acknowledging those locations aren't performing as hoped, which leads into the balance sheet moves.
Okay, yeah, what did they do there?
Well, this was interesting. They boosted their liquidity by issuing $345 million in convertible senior notes, due in 2030 with a 1.75% coupon.
Convertible notes. So debt they can turn into stock later?
Precisely. It's a way to raise cash now, potentially dilute shareholders later, but it really beefed up their liquidity. They now have about $556 million available, including nearly $40 million in cash.
So using that cash flexibility for...
Supporting the new buyback, paying the dividend, and also paying down some existing debt, so definitely shoring up the finances. Proactive.
Okay, which brings us squarely to management strategy, right? This whole brand reset thing.
Yes, a huge theme on the call. They were very open about acknowledging their word was a misstep with that recent brand refresh and the store remodels.
Wow, admitting they got it wrong. That's pretty direct.
It is, and you could almost hear the collective sigh of relief from longtime customers. They've switched back to the classic old-timer logo.
The one people know and will seem to love.
Exactly. And crucially, they've paused all the remodels. They even went back to the 4 test stores that had the modern look and restored the traditional interiors.
That's a serious backtrack. Sends a clear message, doesn't it? Like, we heard you. Heritage matters.
Absolutely. They're signaling guest feedback is paramount right now, and the focus is shifting squarely back to the kitchen and the guest experience itself.
So less about the look, more about the food and service.
Seems like it. They talked about process changes to improve signature items, biscuits, meatloaf, green beans, accelerating testing on other core menu stuff too.
Getting back to basics.
Yep. And continuing with a program to optimize the back of house, aiming for better food quality and efficiency. And they introduced something called the Herschel Way.
Chuckle slightly. The Herschel Way. What's that?
New service principles, apparently inspired by Uncle Herschel, all about emphasizing that warm, sort of folksy, traditional hospitality.
Okay, leaning hard into the nostalgia and the expected Cracker Barrel feel. Back to Grandma's kitchen almost?
Feels that way. And it wasn't just tweaks. They're making portfolio changes too, closing 14 Maple Street Biscuit Company units.
Tying back to that impairment charge earlier, sharpening focus.
Exactly. Sharpening focus on the core Cracker Barrel brand while actually opening 2 new Cracker Barrel stores, streamlining and doubling down on what they think works.
Amidst all this, any bright spots?
Actually, yes. The Cracker Barrel Rewards loyalty program. It's been a huge success.
Really? How successful?
Over 9 million members in just 2 years. Accounts for over 35% of the sales they can track.
9 million. That's substantial.
And here's the really interesting part. Membership growth actually accelerated recently. They signed up 400,000 members just this quarter so far.
Wait, even after the whole logo controversy?
Yep, 300,000 of those joined since the logo change on August 19th.
Wow. Okay, that is surprising. Suggests a deeper connection, maybe? People still want to engage despite the missteps.
Seems that way. And to keep engaging them, they're launching something called Front Porch Feedback. Lets loyalty members give input right after a visit.
Direct line to the customer.
Yeah.
Smart. And marketing.
Leaning into nostalgia, brand heritage, upcoming ads focused on college football, probably hitting that demographic that appreciates the classic feel.
Makes sense. Okay, so that's the operational pivot. But you mentioned the guidance was the big market mover. Let's get into fiscal 2026.
Right. This is where things got concerning for investors. The outlook for total revenue is between $3.35 billion and $3.45 billion.
And how does that stack up?
It's below what Wall Street was expecting. Pretty conservative.
Yeah.
And the main reason, they're anticipating annual traffic declines between 4% and 7%.
Ouch. 4 to 7% fewer people walking in the door. That's a big headwind.
It is. They even said that since that August 19th logo change, traffic dropped about 8%.
It's an immediate impact.
Yeah. They expect Q1 traffic to be down 7% to 8%. They do expect it to improve sequentially through the year.
A slow climb back.
Hoping for a meaningfully higher rate of improvement in the second half. But yeah, it's clear the brand issue hit traffic hard and fast.
And how does that square with pricing? Are they cutting prices to get people back?
Actually, no. Despite forecasting lower traffic, they plan menu price increases of 4% to 5% for fiscal 26.
Whoa. Raising prices when traffic is falling? How do they justify that?
Their confidence comes from a few places. They believe the brand still has strong value perception. Their average check is lower, like $15 compared to over $18 for broader family dining.
So still seen as relatively affordable.
That's the argument. Plus, they use a barbell pricing approach, keeping some low entry-level prices while offering premium options. And they said their internal value scores are still improving.
Banking on that value perception, holding up against price hikes and fewer customers. It's a gamble, isn't it? Especially with consumers being so price sensitive.
It absolutely is. And that feeds directly into the profitability outlook, which is where investors really got spooked.
How bad is the EBITDA forecast?
Fiscal 26 adjusted EBITDA is guided between $150 million and $190 million. Compare that to the $224 million they just did in fiscal 25. It's a significant drop.
A big drop. Any particular quarter looking worse?
Q1 specifically is expected to be way below last year. Partly lower traffic, but also about $16 million in extra costs hitting that quarter.
$16 million. For what?
Marketing, advertising, trying to fix the brand image, plus their big general managers conference happens then, and extra manager training. So, yeah, Q1 earnings are going to take a hit.
Okay, that definitely paints the picture of why the market reacted the way it did. What about spending? Capital expenditures.
They're pulling back there, too. Fiscal 26 CapEx is projected at $135 million to $150 million.
And where's that money going?
Mostly maintenance, about 60%. Then 35% on tech and strategic stuff, only 5% on new stores. And here's the kicker. 0 spending on new remodels.
Wow. Direct response to the feedback again. Slamming the brakes on those controversial remodels.
Completely. And they also signaled that fiscal 27 spending will be well below what they previously guided for multiple years out. Much more conservative capital deployment.
Got it. Any other cost pressures they mentioned, like those tariffs?
Yeah, they expect tariffs to add about $25 million in extra costs year-over-year in fiscal 26.
Ouch. Another headwind.
But they say they've put things in motion to mostly offset that. Negotiating with vendors, changing the product assortment, like not selling stuff if it's unprofitable due to tariff shifting where things are made.
Trying to mitigate it.
Right. And even cutting down the number of different items they sell, SKU years, by about 10%. So actively managing those external pressures.
Okay, so putting it all together for investors, the market reacted sharply, shares down 9 and 10% after hours. Lots of bearish options activity, puts being bought.
Yep, indicates people were betting on further downside. Seems like investors focus way more on that cautious guidance and the near-term problems than on the Q4 revenue beat or management's quick pivot on the brand.
It's become a prove-it story, basically. Show us the recovery.
Definitely. And this whole situation reflects the tough environment for restaurants generally, right? Mixed traffic, customers very sensitive to brand perception and maybe price changes.
Yeah, even though the broader consumer discretionary sector, XLY, has done okay, restaurants as a group have lagged a bit lately. Cracker Barrel's not totally alone in facing challenges, though some of theirs are self-inflicted.
Fair point.
So if you're watching Cracker Barrel stock, what are the key things to look for in the next, say, 1 or 2 quarters?
Number 1 is definitely sequential traffic trends. That Q1 forecast is down 7-8%. Can they show improvement in Q2, Q3? That's critical.
Got to stem the bleeding there.
Exactly. Also, any updates on that remodel pause, progress on the new food initiatives, and are they actually making money from that big loyalty program? Those will be key catalysts.
And if they beat their own cautious guidance?
Could see the stock re-rate higher. But if traffic stays weak, the valuation will likely stay low. The next few quarters are really make or break for the narrative.
All right, time for our favorite segment. This is not financial advice. Just a reminder, folks, purely for discussion, entertainment. We're not advisors. Do your own homework before any investing.
Always. But let's throw out some ideas, some plausible, maybe slightly outrageous takes.
Let's start with the bull case, the optimistic view.
Okay, the bullish bet could be: the market totally overreacted. This brand thing was a temporary, self-inflicted wound, and management fixed it fast.
They did pivot quickly back to the old logo, paused remodels.
Right. And that loyalty program, over 9 million members, still growing fast even after the backlash. That shows resilience, a management that listens.
Plus, the underlying stuff wasn't all bad. 5 quarters of restaurant comp growth, decent EBITDA growth last year if you adjust better labor costs.
Exactly. Maybe the market's ignoring the operational strengths, plus they shored up the balance sheet, they're doing buybacks, paying dividends. Signals confidence, right?
So the bullish trade idea?
Simplest is just buy the stock, bet on a comeback. For a bit more hedge fund flavor, maybe buy some out-of-the-money call options, say expiring mid to late 2026.
Betting on what exactly?
Betting that traffic recovers faster than expected, the nostalgia marketing works, loyalty kicks in, food quality focus pays off, and the stock gets re-rated from brand blunder to resilient comeback.
Okay, plausible. Now, the flip side, the bearish bet.
The bearish argument. That big stock drop and the weak guidance, not an overreaction, but reality setting in. Maybe the brand damage is deeper.
Suggests the disconnect between management and the core customer. Could take longer, costs more to fix.
Could be. Plus, competition in value dining is fierce. Consumers are price sensitive. Can they really push through 4 or 5% price hikes without losing more traffic?
And the balance sheet moves, maybe just defensive, don't solve the core demand issue if people aren't coming back.
Right. And maybe the cost savings get eaten up by the expense of winning back trust and driving traffic. That $16 million extra cost in Q1 might just be the start.
So the bearish trade idea.
Short the stock is the direct play. Or, for more leverage, maybe buy near-term out-of-the-money put options. Target Q1 or Q2 next fiscal year.
Capitalizing if the traffic recovery is even slower than guided, or if those brand repair costs keep climbing.
Exactly. You could even do a pairs trade. Short Cracker Barrel, go long a competitor in the value space that is showing consistent traffic growth, bet on the performance gap widening.
Interesting. So, wrapping this all up, Cracker Barrel's Q4 was really a story of two parts, wasn't it?
Absolutely. Some decent execution in the quarter itself, revenue beat. Restaurant comps okay, but totally overshadowed by a really cautious outlook for next year.
Driven by those traffic headwinds from the brand reset and the costs needed to fix it.
Yeah. Management's quick pivot back to tradition, focusing on food, service, that loyalty program. Those are clearly the pillars for their path forward now.
But the market needs to see it work. Needs proof in the biscuits and gravy, I guess.
Chuckles, pretty much. It really highlights that tension for established brands, you know? How do you evolve without alienating your base, especially when your identity is so tied to tradition and nostalgia?
It's a tough balancing act. So the final thought for you listening. Did management make the right call pulling back so hard? What are you watching for next quarter? Let us know your thoughts. Until next time, keep those tickers ticking.